Welcome everybody. Thanks for tuning in. This is the Capital Financial Group Q3 recap and market update. So let's jump right in, chat about what's going on in the world. Just as a refresher, last quarter we covered a few important topics. Specifically, we covered GDP, we covered PMI, we talked about wage inflation just a little bit, and we also touched on inventories. This quarter, we're going to do it just a little bit different. There's going to be a little bit of overlap, but a couple of new items. We're going to talk about wage inflation in regards to earnings, and then also going to revisit GDP here in the United States, in the European Union, and in China. So without further ado, let's talk about the United States of America. The S&P 500 is up just about 19% so far this year. Pretty amazing start to the year, but not a whole heck of a lot going on during the third quarter, with the exception of volatility. Volatility is real. We warned you guys about this. We've been talking about it for months, if not the better part of the last year. We saw the volatility index increase over 100%. From trough to peak during the quarter. And we also saw pretty meaningful declines in U.S. equities, about over 6%, almost 7% during the August period. So we're going to take a look at a chart real quick on that. So what you have here is we have a chart of the S&P 500 in blue with an overlay of the VIX in orange. I've conveniently put a correlation chart at the bottom here showing the negative correlation between stock prices and the volatility index. This is a 10-year look back, so I kind of want to focus on the last couple of years. We've seen a real tight correlation in ups and downs in the market and ups and downs in the volatility index. I think this is going to become a little bit of a new normal per se, even though back in the day, we saw this negative correlation seem to be at least a little more true. But we were spoiled at the first part of this bull market. We didn't see a whole heck of a lot of volatility, as you can see, from about 2011 all the way up until the beginning of 2016. There was almost nothing happening in the volatility index or the market going down for that matter. So just something to keep an eye on, and I wanted to bring your attention to the negative correlation there. So it's no coincidence that we've seen increased volatility and some downward pressure on equity prices here in the United States, because we've seen a little bit of negative momentum in U.S. GDP. People are talking about it all over television right now, predicting the next recession, yada, yada, yada. Fortunately, what it kind of looks like right now is the actual rate of change of GDP growth has calmed down just a little bit. So it's not quite as negative as it was a couple of quarters ago on the margin. So I have a chart here I want to show you guys. And what I think is really interesting about the chart is back when Trump took over the presidency, we saw pretty steady increases every single quarter in GDP. And that peaked out in Q4 of 2017. Things slowed down just a hair, and then we saw another retest of all-time highs as far as accelerating GDP in the second quarter of 2018. Pretty interesting little piece of information here. We saw the trade war and the tariffs kind of kick off in Q3 to Q4 of 18, and once the tariffs actually went into effect, that's when we started seeing the United States GDP slow down. Now, it hasn't been a massive slowdown, as you can see. We're not contracting. It's not a recessionary environment. We're just not growing nearly as fast as we were about a year and a half ago. An important call out here regarding GDP slowing is that the actual bottoming process could take up to 2 years, and at that point, recession is likely in the cards. So we have a little bit more time if history repeats itself at this point. Moving over to earnings, everyone's talking about how earnings season wasn't nearly as bad as we were expecting, and this is kind of a double-edged sword. It is correct, it wasn't as bad as everybody was expecting or that we originally called for in the last video, But I think it was mostly due to earnings revisions a little bit lower. So the benchmark wasn't quite as high for people to beat, in which case we saw more earnings beats than maybe we were expecting a couple of months ago. There are some really interesting headwinds developing in the labor markets. Obviously, it's really nice that our unemployment levels are as low as they are, right around 3.5%, give or take just a little bit. This is putting pressure on corporations to raise wages. On the surface, this seems awesome. For Americans, it's fantastic that we have such a tight labor market because everybody's making more money. The caveat here is sometimes corporations are forced to hire people who aren't necessarily super qualified for their jobs, and they might be forced also to overpay for these positions. So this X on your screen is just a chart of U.S. wages and salaries for non-government workers with an overlay of the U.S. unemployment rate. As you can see, this is almost a perfect negative correlation. That should be the word of the video. Really interesting to see how, with continued downward pressure on unemployment, we are seeing dramatic increases in wages. And people don't even really give this much credit, but at some point we're going to hit a tipping point where companies are not willing to pay more for marginal to subpar labor. And frankly, at some point in time, we're also going to run out of new workers. It's kind of a demographic thing, which we've touched on in multiple videos, but we're not going to go there today. Where we are going to go today is politics. We have a presidential election coming up next year, and there are crazies on both sides. I don't really care where you fall on this one. You know this is going to be good TV with all the personalities we're dealing with. The presidential election cycle is always interesting to study. During an election year, generally we see the markets cooperate. Almost every single time U.S. stocks are higher. And the driving force behind this is the sitting president doesn't want to have an awful economy and a stock market that's not cooperating come November of his election year. So there could be potential for some sort of regulation cutting or some sort of tax package just to try to buoy the market all the way into the election. Now, the caveat here is we could be in a situation that the impeachment of Donald Trump spooks the markets. We've seen impeachments in the past go two different directions. Take a look at this chart right here with the impeachment of Richard Nixon. As you may note, the impeachment proceedings started in early 1974, and we had the S&P trading at right around 100. By the time Nixon resigned in fall of 74, it had dropped all the way to 70. And it bottomed out in the low to mid 60s before turning around and recovering slightly the following year. This is also a chart of the S&P 500, but this is completely different. This is the Clinton impeachment. Whole different animal. Can't tell if the numbers are skewed a little bit because we were at the tail end of the dot-com bubble or not, but you can still see that there was some volatility. Markets dropped a little bit as impeachment proceedings started. And then by the time he was exonerated in early 1999, the market had actually fully recovered and started its upward momentum from there. We all know what happened in early 2001, but that has nothing to do with the actual impeachment of Clinton. So the only thing we know for sure is that we don't really know anything when it comes to this impeachment process. We have no idea what's going to happen to markets. All we really know right now is that Democrats think that Trump's going to get impeached, and Trump doesn't think Trump's going to get impeached. So we got that going for us, which is nice. Moving over to housing, this is a bright spot right now. Existing home sales have been pretty solid. The high employment and wage inflation has been really beneficial to millennials and people getting into their first houses. The lower to mid-level pricing structure in homes has been incredibly buoyant, and we've seen a little bit of an issue with times on the market and overall supply for really expensive houses, but historically speaking, they've always taken longer to sell. Let's take a look real quick at the existing home sales chart. This chart goes back 5 years, but I want to focus on the second half or the right half of the chart. As you can see, existing home sales numbers kind of peaked coinciding with when we saw the GDP peak back in early 2018. There was a steady decline into the beginning of this year where we saw kind of a floor under the market, and not so coincidentally, we also saw interest rates start to drop again, which encouraged people to get back in the housing market. This is also, if you remember from the earlier chart, when we started seeing additional wage inflation, and we also saw the unemployment rate bottom out. So all these things are working in concert to be very, very helpful for the low to mid-range housing market. The natural progression from housing and mortgages is over to domestic fixed income. Before we get into what's going on exactly in the fixed income markets, I wanted to give you guys a quick reminder that the 10-3 curve is still inverted. And what that means to us is essentially that at some point we're probably going to have a recession. I know we don't like to talk about that. Some people say it's imminent. Other people are saying it's never going to happen with Trump as president. Nobody knows for sure, but I doubt it. It's really challenging to predict. But if history is any indicator, it's going to happen sometime between the next 12 and 24 months. Just guessing based off of our charts. Moving over to U.S. fixed income, yields have dropped pretty drastically this year. Combination of things going into effect. Some of it is flight to safety, flight to quality during periods of volatility. Other parts of it are primarily driven by the actual Federal Reserve itself cutting rates. They primarily focus on the short end of the curve. They can really only control the shortest lending rates. Everything on the longer end of the curve, 10, 20, 30 years out, all that is going to be supply-demand driven by people trying to chase yield or just simply avoid risk for the long term. This can be anything like other governments, our current municipalities and their pension programs. Pretty much you name it, there is demand out there for fixed income, especially in volatile periods. Everybody thinks fixed income is boring. We all know that high yield's not boring, but I think people are finally starting to realize that even treasuries can be exciting and not boring. Clients sometimes call and they say, hey Alex, why do we have bonds? We're going to lose money or they're just not going to do anything. I want to show you this chart right here to give you an idea of why we have bonds in your portfolio. The orange line is not stocks. It's actually the 20 plus year Treasury ETF. The ticker is TLT on that. I just picked this one because you can't really hide here. There's nothing active or exciting happening inside of this particular ETF. This is just 20 plus year treasuries and the price action that's happened over the trailing 12 months. The purple line is the S&P 500. Yes, I know it's crazy to look at this, and you guys are probably saying, whoa, Alex, you're cherry picking to prove a point. This is literally just the trailing 12 months, and we've had volatility, so we're seeing benefits of diversification in the portfolio. If we use the same chart just for this year, it wouldn't look so different. I mean, if you start in January, we still have really solid returns in fixed income, even though equities have cooperated more this year than they did last year. So we feel like there's a bit of a floor under fixed income at this point, and that's primarily because the Federal Reserve has just started their rate cut cycle. We're only a couple cuts in at this point, and they have plenty of more room to run if they need to. The same cannot be said for the European Union. The ECB has pretty much exhausted all options, and the EU is still very, very weak with very weak growth. But as we opined last quarter, things when they're awful have a tendency to get less awful, and eventually they could even potentially get good. So let's take a look at this European Union GDP chart. So we decided to time this chart out by starting with the most recent bottoming process. Even though they didn't technically go negative in their GDP, it was pretty darn close. If you can tell right towards the right side of the screen here, in about Q2 of 2018, we started to finally see a legitimate acceleration to the upside in GDP. Now, granted, they're still only growing at about 1.5 to 1.6%, which isn't great by any stretch of the imagination, but it is a heck of a lot better than zero, which is where they were really close to just less than 2 years ago. Now, a reason to be positive on this whole thing is that the ECB is extremely dovish in their monetary policy. We're talking negative interest rates all over the place, and this really rewards people that want to take risk. We also have extreme weakness in Germany, and the German government is finally at the point where they are considering a form of monetary stimulus. If they do this, there's a likelihood that other governments in the European Union would follow suit. If we move over to the neighbor of the EU and former EU member, Great Britain, we are dealing with a total dumpster fire. I mean, there is no other way to explain Brexit at this point. Their new Prime Minister, Boris Johnson, has zero confidence at this point. He tried to tell everybody in Parliament to take the rest of the year off so he could handle Brexit on his own, and that blew up in his face when the British Supreme Court told him that he was breaking the law. So there is no end in sight on Brexit. I know they're supposed to have a deal by the end of the month here, October 31st, but the long and the short of it is they're probably going to kick the can down the road again. So we'll have to see how that whole thing plays out. Moving from one geopolitical dumpster fire to another, we will talk about what's going on in China. China is continually growing at a faster rate than all of the other more developed countries in the world, but they are finally slowing down, as is evidenced by this Chinese GDP chart. China is struggling mightily. For the first time ever, we are starting to see them even admit that they can't keep their growth up. They had years and years of aggressive infrastructure spending, unlike anything else we've ever seen in the world. Coming from almost double-digit growth perpetually, we've seen them start to slow down. This chart shows Chinese gross domestic product. People are saying we're winning. Look at that downward angle. Here, pull the chart up. Yes, the downward angle is getting more severe. We are actually at the point where they're growing at about 6% at this point in time, and the Chinese government is legitimately admitting that that's going to be hard to maintain that moving into the future. I would wager to guess that China is going to have to come to some sort of deal with our tweeter-in-chief in the relative near future, just because growth is slowing so rapidly and the tariffs have had such a striking impact on their growth over the last year and a half. All the drama surrounding the tariffs and all the uprising in Hong Kong and in China is really not even close to what's going on in the Middle East. Now, granted, we don't cover it quite as heavily here in the United States, but the Middle East is an absolute hotbed for geopolitical drama. If you've been living under a rock, let me get you up to speed on things. Basically, Iran, either directly or indirectly through some form of terrorist funding, has attacked the infrastructure for oil and gas production in Saudi Arabia. On the surface, this would seem like it was an incredibly damaging event for global markets, but this really just shows how insignificant Iran really is on the global financial markets, as generally speaking, stock markets haven't really even cared. The same cannot be said for commodities markets, and most specifically the oil market. As you can see, oil has been all over the place, and there isn't anything really telling with the chart just at first glance. If we look at the last 2 months, though, we see a major spike in an extremely short period of time here in August, and that is obviously when we had the attack on Saudi Arabia. Now, Saudi Arabia claims that they are going to be able to get back to full production in the next week or two. I think anybody that knows anything about oil production knows that that is not even remotely close to being possible. So we wouldn't be surprised here at CFG if we saw oil prices climb steadily throughout the rest of the year. What that means for oil stocks isn't necessarily that there's going to be incredible outperformance in that regard. We're just specifically talking about the oil prices themselves. Now, just like last quarter, I want to close this whole thing out by pointing out a couple of bright spots. Number one, we have employment at one of the highest levels in history, which is absolutely fantastic. We also have wages increasing steadily, which is amazing for the consumer. And then global stock markets have been really cooperative this year. The S&P 500's up a little over 15%, even though we've had a little weakness the last few days. The MSCI EFA, which is our developed international index we track, is up a little over 9%. And even emerging markets, which have been having a really hard time with all of the US dollar strength, are still returning a positive 3.4% this year. With that in mind, data will always dictate our positioning. Our portfolios here are definitely focused on risk management, and with that, we have to be mindful of volatility. So as we're this late in the cycle, we are going to continue to focus our domestic equity exposure or our stock exposure on lower beta, lower volatility as an overweight for us, not quite as much in the growthy part of the stock market, and we're also going to continue to tilt a little bit of an overweight to international stocks as well. High quality fixed income is a staple in the portfolios, and we are going to continue to keep a bit of an overweight to our alternative asset sleeve. Underweights would be very aggressive emerging markets that are US dollar sensitive, as well as a various basket of commodities. Remember, hope is not an investment strategy. We're so thankful that you took a few minutes out of your day to watch this video, and we really hope that it provided you an opportunity to learn something new and gave you an insight into our thought process and our research here at Capital Financial Group. If you need to schedule your quarterly review, please give us a call, or if you're new, use the link below to schedule a free consultation. Thanks again, and we look forward to seeing you in the new year for our next update. The election next year has a whole lot going on. Early, I just don't even know what I just talked about.